Welcome all to the node. I am Mike, aka Veteran Crypto, and joining me shortly will be David. While we wait for him, let's go ahead and jump on into a little bit of news. But first, let's actually touch on this. So, if you're watching this after the live show, this is our official website, thenode.pro. And this is where you can find all the free stuff that we give away. So, a lot of channels, they like to charge. A lot of people like to charge for the educational material that they offer, or the community. We give it away. So, if you want to learn about, the traditional banking system, fiat, how it all works, crypto, DeFi, all of these things, uh, we had to figure it out on our own. Most people that were early into crypto, I mean, we're still kind of early. We had to learn through trial and error for the most part. Here at the Node.pro, we give it away. So if you want to learn about any of this stuff, go ahead and come here, go to the Learn tab, and you can start your journey. Start learning wherever it is that you are in your journey from beginner, intermediate to advanced. You can get spun up and accelerate your education. There's no tricks, no gimmicks, no credit cards needed. Just sign up, and so that it knows when you come back, it knows where you were at and stuff like that, and keeps track of your tests, because there's tests and quizzes, and so you need to have an account. But other than that, it doesn't cost anything. The community. This is it's kind of like Discord, but we decided to move away from Discord. We want to have full control over our community and what we're allowed to do and say and things like that. So we built this out, and this is where we just share information. And again, totally free. Just make an account, and you'll be able to chat with the community, ask questions if you have any concerns, if if your wallet isn't working, whatever it is. Just come in here, and this is a great resource. The Intel library. So this is the deep dives. We do at least 10 of these, sometimes up to 13 of these a week, and this is the repository. This is where we put all the different deep dives that we do here live on the show. So if you want to go through them at your leisure and fact check them even, and each one of them has the source document that we build it off of, with all of our primary sources cited. So we don't just say, trust us, bro. We give you the links. We give you the material that we use to come up with the information about, how the platform works, the tokenomics, the who funded them, just all the different basic alpha that you need to know before to start you off, so that you can decide, is this something that I even want to bother doing a deeper dive on, or is it something that I'm just not interested in at all? So what's up, David?
Oh man, just got and just chilling, man. Just chilling. I got these teeth whitening strips, dude. I put them on for the first time this morning, and those things, man, like, I think they're gonna bleach my teeth off. God damn. Crazy. I don't know that I'm going to use those again, but yeah. So yeah, not a whole lot. Just been taking it easy this morning.
Nice. Well, let's go ahead and start jumping into the news that I got. So one of the things that I'm wanting to talk about in the first half of the show, other than just going through the news, is I really want to focus on, not just what tokens big money is buying right now with the markets down like they are, but I really want to start digging into what smart money is investing in when it comes to crypto. Not necessarily what companies they are investing in, but what tokens they are buying. So there's a difference. Those that are somewhat new to crypto, just so you understand, when these are not securities. There was a whole court case, and many of the tokens, crypto tokens out there, they are not securities. There is no legal contract between you, the token holder, and the company. And we like to keep stressing this, because a lot of people, I think when they're new to crypto, I was one of them, I thought by buying the token that I had a vested interest in the profitability or the success of the company, that launched it, that I was helping bootstrap giving them bootstrap liquidity to build their product or service, and that gave me some sort of claim on any success that they had, and that is not the case.
Mm-mm.
So we have started focusing very heavily, and I've noticed that other channels are following suit. We have started focusing very heavily on value capture. And value capture, I can't stress the importance enough, because it is the only mechanism that exists currently where we, the token holders, have a not a guaranteed avenue to share in the profits, but it is really the only way, other than pure speculation, that we have to share in the profits of these companies that we're investing in. Because other than speculative pumps, basically just a bunch of retail buying a token, that's really the only thing that has moved. Buying and selling a token is really the only thing that has moved the prices of these assets, and so far there is.
Mike, as you're speaking there, what I was thinking about is, you remember how there have been a couple of, I think Standard Chartered is the institution that came out with some research on Uni and Aave, those two tokens. And it might be a good idea if we dig up that research report from Standard Chartered on those two tokens. I'm sure we can probably find it just with like a Google Gemini search or something like that. The reason I'm bringing that up is they assigned, they just basically applied like a discounted cash flow analysis, DCF, to these digital assets. And what they said was, hey, these things, in 2030 could be, worth 30 times or 50 times or 100 times what they're worth right now. Like they said that they're massively undervalued right now. And I just want to see exactly how they did that, how they got to their price targets. I'm very, very curious to see that, because I'm kind of dubious of that. So, yeah, man, I'm just not convinced that the value accrual mechanisms for a lot of these altcoins are solid. I just don't think that they're super solid yet. I can, off the top of my head, there's only like a half a dozen coins that have really super solid value accrual mechanisms where they meet our trifecta. They've got real user growth, real users use the protocol, use the coin, use the chain, and those users drive real revenues, and those revenues accrue to the token. There's only a handful that actually do that. And Uni and Aave, I believe that there are mechanisms by which there is value accrual for those tokens, but I really want to dig into that Standard Chartered research. Let me see if I can find it as you bring up Robinhood.
I'll do that. One thing that I'll say is, I know that Uniswap, if I'm not mistaken, they quietly made some changes recently that took value capture away. Like initially they came out and it was it was very bullish for the token holders, and then I believe it was on V4, which is basically where all their liquidity is pretty much moving. They dialed back the amount of kind of the buybacks and burns and things like that they were doing, or the value capture that they were allowing.
They call it the fee switch. They call it the fee switch. Yeah. So, but that's different than what they did with V4. So with V4, what they're doing is they're actually extracting a third of the fees that are generated when users swap asset A for asset B in a V4 pool, but they're not doing that on the base chain.
Yeah.
Right. Now, Mike, I've seen on X recently, within the last couple of days, as this Robinhood chain is launched, I've seen a lot of people just dumping on Coinbase and the base chain. A lot of people very upset with the base and the base chain because they're seeing the success of Robinhood chain. And they're like, hey, base chain's been around since 2023. Why have we not gotten this success?
Well, because look at the amount of users that Robinhood has. They have a massive amount of just users baked in, and they are they had a bunch of people already onboarded in TradFi. So that's really what's fueling that, is that they have a much larger client base than Coinbase. Coinbase is growing and Coinbase is huge, but nothing like Robinhood.
Yeah, well, I mean, all I'm saying is that on X, I've seen a lot of people that are upset with the performance of the base chain.
They don't understand. They don't understand that. The role of like what we teach, the trifecta, adoption. If the amount of people that you have onboarded is a huge part of your business. The customer base, because with the massive amount of customers that Robinhood had existing, then you get those fees, that revenue that gets generated. And there is no token for the Robinhood chain, or so people have been buying ones like this index. And it had a huge surge of 150%, but it also had a massive pullback. So the cash cat, it took off, made people a bunch of money. It's had a huge pullback. That's just crypto. A lot of people, they follow the narrative. That's where there is value in speculation.
So check it out. So Mike, can you guess how many customers Coinbase has? How many total registered users?
I would guess
it's a lot. It's in the 9 figures, bro.
Oh yeah, no, I'm sure that it's a lot.
115 million registered users on Coinbase. And do you know how many are monthly active users on Coinbase? 9 million.
Okay.
So on Coinbase, you've got 9 million monthly active users that make at least one transaction per month. But they've got 115 million total registered users. Now, Robinhood has 27 million funded accounts. So their monthly active user base at Robinhood is, let's call it 12 million. So if Robinhood has 12 million unique users.
Now look at their volume, look at their, the amount of money that's being moved.
Yeah. So I'm just thinking about like, okay, what's the total number of users, right? So Coinbase has fewer monthly active users than Robinhood does, but that's just one, not by much, but that's just one metric. All I'm trying to say here is that the launch of this Robinhood chain has been a phenomenal success.
Oh, absolutely.
So far. It really does remind me of the launch of the base chain. And so Mike, in August of 2023, when the bull market was just getting started, this past bull, that was when the base chain launched. I remember when Aerodrome launched in that first week. I was trading on Aerodrome the week it launched. Like I could have even been the day it launched, I think. Man. So this launch of Robinhood, it reminds me a lot of the launch of the base chain, except that Robinhood's launch, this chain, I think has been a bigger success than the launch of the base chain. But we need to be able to compare apples to apples. So, right now, me saying I feel like this, I don't like feelings. Okay. I try to suppress that.
And that's why I was asking about, because I'm curious, I'm curious about the volume. I'm curious about, the amount of money that's being moved.
Yeah. So another thing that I'm thinking about here is, when the base chain launched, a great way to take a look at these new coins that we're launching, these new protocols that we're launching with protocol coins on the base chain, because there were some amazing opportunities when the base chain launched for these protocol coins. One of them that comes to mind is Alien Base. So Alien Base was I think it still exists, was an AMM liquidity provision DEX that launched, I think it was like the first week the base chain launched. And the token was, I think it was ALB. I think it's still around.
It's still around.
Yeah, so Alien Base, man, that's just an example of a DEX token that pumped. It went from $0 to like $12, if memory serves, like within that first week, and made a ton of money. So there are probably going to be similar opportunities, like an Alien Base type opportunity, but on the Robinhood chain, now that this chain has just launched. So I think it's probably a good idea that we take a look at these new protocols that are launching that are Robinhood chain native.
No, absolutely. So what's some of the numbers?
Okay, so what are the important metrics to compare the base chain to the Robinhood chain? I wonder what some of those important metrics are. Off the top of my head, it would probably be, users, of course, transaction, like number of unique transactions, transaction volumes in US dollar terms. Um, it looks like these two chains are built on quite different underlying tech stacks. So the base chain is built on Optimism's OP stack,
Yeah.
which is an optimistic roll-up framework, which is, a lot of people have been dumping on that OP roll-up framework. So it uses, the base chain uses standard EVM tooling, relies on Ethereum for data availability via blobs. And those blobs, we actually ran deep dive research on that when we ran through Ethereum, maybe 2-3 weeks ago, something like that.
Mm-hmm.
And how everyone was saying that the layer 2 chains were parasitic, that they were like a vampire attack
They're
on the net.
extractive, off of
Right.
the layer 1. Yeah.
Yeah, but I don't think that that's true with the advent of these blobs. I think that, based on the deep dive research that we ran through, and we can actually pull that up, so that deep dive research on Ethereum, if I just, hop into the Intel library and bring up Ethereum, let me see if I can find it. Ethereum, there it is. So I brought up the deep dive research on Ethereum, and if I just search within this for blobs, okay, so I've got it pulled up now. So we can actually take a look at real data on blobs. And I can share my screen here. We can take a look through this. I believe that according to our deep dive research, that these blobs with so it was the Fusaka upgrade in December of 2025. Let me just zoom in a little bit further so we can all see this. So there were a couple of recent protocol evolutions on Ethereum. Pectra, this upgrade in May 2025, Fusaka in December 2025, and Glamsterdam, which I think was just like done recently. So blobs, my understanding of blobs is that they act as a sink for ETH, so that ETH gets burned when there are more transactions on the layer 2s. So the big controversy was, you got all these layer 2s, you've got all these transactions that are occurring off the mainnet, and that is extractive of value from the ETH coin.
Yeah.
But with this upgrade using blobs, my understanding of this is that it actually acts as an ETH sink, and that should make the token deflationary over time. That was my understanding.
Yeah, and I know that we looked, and as far as the fees being generated on the Ethereum chain, I know that they were like 6 figures. I mean, they were super, super small. Unlike in the past, before they, kind of fixed the gas, because, those of us that have been around a while, you remember the $100, $200 or more transaction fee.
Oh my goodness. Yes, I do remember that.
I mean, if you wanted to play in DeFi on Ethereum mainnet, you needed to have some sizable positions, because just to basically so the transaction fees didn't eat up all of your profits.
True.
So yeah, let's actually talk a little bit about the title of today's show. So there's one specific project that and we've been talking about it, is Hype. And it looks like that major institutions are interested. So it says here that Wall Street has been quietly and steadily establishing a footprint in Hyperliquid's Hype token, marking a major institutional rotation toward the high-performance decentralized perpetual exchange. This isn't just retail hype anymore, no pun intended. Massive financial heavyweights are positioning themselves to capture Hyperliquid's powerful fee generation model. So, who's buying? Goldman Sachs and Hyperliquid Strategies. Goldman Sachs 13F filings revealed a 3.3 million stake in Hyperliquid Strategies, a private digital asset treasury vehicle modeled closely after MicroStrategy's Bitcoin playbook. The treasury actively accumulates and holds Hype, meaning Goldman has secured indirect exposure to roughly 20 million Hype tokens. Andreessen Horowitz, wallets linked to the venture giant, have aggressively accumulated roughly $148 million worth of Hype, locking a massive portion into staking protocols. Staking this volume signals a long-term yield generation strategy rather than short-term speculation.
That's a big deal.
Yeah,
A16Z, those guys, those are smart guys, man.
absolutely.
And Mr. Horowitz, he's got a head that makes him look smart.
He has an 18-pound head.
Yeah, dude. He's got what was the name of that show? It was a movie, right? Where they had like, these heads that look like domes.
Cone heads.
Yes, cone heads.
Yeah. It's an old, like, I believe it was a 90s movie from a Saturday Night Live skit.
Yeah. He's a smart dude, and the wealthiest VC on the planet. So very, very smart. If he's accumulating hype, it's probably because it satisfies our trifecta. I think he's been watching the show, Mike.
I think so. That must be the secret to his success.
Exactly.
All right. So we got these spot hype ETFs. The launch of a spot hyperliquid ETFs such as Bitwise's BHYP US ETF has opened direct pipelines for institutional capital, recording millions in rapid net inflows with zero outflow days during their initial trading weeks. Is there any way you could look that up, David?
Potentially. I wouldn't know where to go. I might start at Dune Analytics to see if I could dig up some data on that.
I mean, if you can find something, I would appreciate it because I would love to validate those inflows to those hyperliquid ETFs.
So just for the ETFs, yeah, we would go to Farsight.
That's what I thought.
Yeah, so I've got Farsight brought up here, and we can just take a look at that real quick if you'd like. So there we go. Let's zoom into this thing, and we're looking for hyperliquid ETF flows. So there we go. So as we're scrolling down here, and now these are measured in millions. So when you see, this is the total net flows over here, this right-hand column. And these
black is inflows and red is outflows, right?
Correct. Yep.
Okay.
And so as we scroll down here, we can see the total inflows, $313 million. Largest inflow day, $108 million. Largest outflow day, $5.7 million. Total net, $313 million into these hype ETF products. So I think that you've got to start thinking that we have to start thinking about the hype token as if it were not a security. What do you want to call this? Because it's not a security, but it acts like a quasi-security. Because if you've got real users that generate real revenues and those revenues accrue to the token, but not through like a dividend payment, through a buyback and burn mechanism, that's a quasi-security, right?
Honestly, I think that they're going to have to come up with a new classification, because I don't think that it's fully a security and I don't think it's fully a commodity. I think that there needs to be, a new classification for digital assets and how they're regulated because there really isn't any kind of contract, the Howey test that they use to decide if something is a security or not. I don't think, I think that court case, in a lot of cases, or the court case when it comes to Ripple and the SEC, I think that was true because when you buy XRP, there is no contract. You're not entering into any legally binding contract like you are with a security. It's basically just like it's a gas token. So it's like when you buy a stock, it's not like that stock is like burned. There's too many differences. I just really think that they're going to have to come up with a different classification.
So the current classification it's something called attach detach. So tell me about the SEC attach detach framework. So that framework that the SEC CFTC came up with, they call it attach detach. So when a new protocol token or any token is created, right? It starts off as a security, and that's the attach phase. And then once it becomes sufficiently decentralized, then it can become like a quasi commodity, and they call that the detach phase. So let's see here. I'm trying to find like a good definition of the asset regulation, the digital asset regulation framework for attach, detach. So here's the attachment definition. So under a current federal securities law, a standalone cryptographic token, for example, an ERC20 token, those are the EVM chain tokens, is generally an asset, but not inherently a security itself. However, when it's sold alongside white papers or promotional promises or an expectation of profit driven by a central core team, then an investment contract attaches to the sale transaction.
Okay.
So that's what makes these ERC20 tokens a quasi-security, I'm going to call them, in the attachment phase. Now, how do you get to detachment? Well, it says that an investment contract can cease to apply or detach over time. So if the issuer's initial promises are fulfilled, abandoned, or if the network becomes sufficiently decentralized so that token holders no longer rely on managerial efforts of a central party for profits, then the investment contract status detaches and secondary market transfers, they cease to be securities transactions. That makes sense. That actually makes a lot of sense.
No, it does.
Yeah.
But I mean, but all of that is, definitely specifically unique to these assets. Because it's not like there's a traditional company. It's not like NVIDIA, is going to slowly become decentralized unless it's like, I don't know, taken over by AI or, freaking robots or something like that. And, it's just interesting to watch how this has evolved, because I've only been in crypto about 6 years now. And when I first got in, I mean, it was just pure speculation. What drove price was, whatever people were talking about on social media. If something was getting a bunch of mind share, something, it would pump. If something, FUD came out, it would dump. And so if you could front run that, that's how a lot of people made money. If you could pick the meme coin that was going to get the mind share, that was the one that was going to 100x. If you could catch it, before it did. And now, we're starting to see things like this, where you have huge institutions, like BlackRock and, and Andreessen Horowitz and Goldman Sachs and, Fidelity, and they're investing in this stuff. And they're investing when retail is dumping. These markets are down hard, and institutions are buying. And it's interesting, and I think very important to understand what they're buying and why. Because if you're not paying attention to that, can you make money? Yes. But wouldn't you rather maximize your chances of long-term success? Or, do you have the attention to stay on top of these markets every day? Because if you're investing in a lot of these speculative assets like meme coins and things like that, sometimes the pumps and dumps happen in a couple of hours, maybe a day tops. It used to be with meme coins, it was, days or weeks. Now, in the span of a day, it can go from, a micro cap to massive, TVL, or a massive market cap, and then go back down to nothing, so you got to be on top of it.
So Mike, you see what No Hype 85 is saying in the chat? It is funny how a lot of people have jumped on the hype train, right? Yeah. But there's a really good reason why people have jumped on the hype train. It's because of cash flows. Cash flows. That's what these institutions are buying. They're buying the user adoption. There's a lot of users on Hyperliquid every single day. They're buying the cash flows, the revenue generation, and they're buying that value accrual. So they see an opportunity here, and I think that we would be remiss if we missed it. So, I'm taking a look over here on Coin Market Cap. And something, Mike, that we talk a lot about when it comes to XRP is, okay, if XRP has a $70 billion market cap and you buy XRP at $1.11, where do you think that that's going to go? Do you think that market cap is going to go from 70 billion to 150 billion? You think it's going to double to 140, 150 billion? I don't know about all that. But if you take a look at something like Hype, well, the Hype token, if those users continue to grow on Hyperliquid and Hyper EVM, because the Hyper EVM chain, that's like the DeFi chain for the hypercore layer 1. So there's all sorts of cool integrations between HyperEVM and hypercore. So that's something to think about, because we haven't really seen the protocols on the HyperEVM take off yet. But if I'm taking a look at the market cap for Hype, and I've got my screen share up for coin market cap, if we take a look at the market cap for Hype, $16 billion right here. So that is significant, right? It's the 9th largest digital asset by market cap right now. But I'm trying to project out and ask myself this question. If the growth on Hyperliquid and the Hypercore EVM continues, where could this go?
Well, and let's keep in mind, along this train of thought, let's keep in mind that that's with the existing market cap of the entire, crypto sphere. So with all of this tokenization that's going on, that we're reporting on, with all of this inflows of liquidity from these institutions and banks and things like that, the overall market cap for crypto could 3, 4, 5, 6x or more. So the top 10 projects might go from being like 70 billion to 3 or 4 trillion. We don't know. Look at Bitcoin. Since its beginning, it went from next to nothing as far as TVL to where it's like what, a third, or like like a third of the freaking overall market cap. It's like 1 point something trillion dollars. So we need to understand that these projects aren't just going to grow on their own. Overall, the whole market's going to grow.
And so this is the total market cap chart for all digital assets. This is over here on TradingView. The symbol is total. So this is the entirety of the digital asset space, currently sitting at 2.2 trillion US dollars. Now, what's interesting about this is notice this beautiful level of trendline resistance. Mm-hmm. So this is the all-time high, which came in at, let's call it $4.25 trillion.
Yeah.
So that was the all-time high in October of last year. Now that is the anchor point. If we use this as the anchor and extend a trend line to the next lower high and extend this to the right, we can see right now the total market cap is pretty close to a very important level of resistance. So remember, the Bitcoin bear market's not yet over. It's getting close, not quite yet over. But what you were saying, Mike, is what happens when we get the next bull? And during that next bull cycle, where could the market cap for all digital assets go from there? If we would just want to speculate on that for a second.
Yeah, let's look at that trend line support on the other side.
Yeah, exactly. So what we do, exactly, resistance. So let's just go ahead and zoom out here from a daily to a weekly. And this is a chart of total crypto market cap. Now, what I want to do here is I want to grab a trend line tool, and I want to use that 2017 high, and I want to extend this to the right. And I'm just cutting off that wick there a little bit. And if we just take a look at this and say, okay, well, if we want to speculate for next bull cycle, where could the total crypto market cap go? Well, maybe it is able to rally by 2029 up to, what do you want to say, 6 trillion? Something like that, 6.25 trillion, maybe something up here. Mm-hmm. So if this pattern just continues and repeats one more time, maybe we see, what is that? Like, that's a pretty massive return. We're talking about, 200%.
Well, so, and also keep in mind that, this is speculation, but, just like to be, transparent about that. But there's a lot of crypto tokens. I mean, there's 54 million different crypto tokens, and we've done some research on it. There's only like 2,000. If you get rid of all the memes, if you get rid of all the vaporware and the people that really aren't building anything, you got maybe 2,000. And then of those, which ones are actually being adopted, which ones are actually generating revenue and fees, to keep the lights on and pay the bills and things like that. There's maybe 200. And so you got to figure that all of that market cap that gets out of those other tokens, potentially, some of it will leave the market, but a lot of it will get reallocated to the stronger projects. I know that I'm doing it. A lot of the projects I was bullish on in the past that don't have solid value capture, I've started selling off.
Yeah.
and getting into tokens like going deeper into Canton, deeper into Bitcoin, deeper into
Yep.
Hype, deeper into Tron, deeper into these other projects at these lows, because I mean, to me, it's obvious what projects are kind of outperforming the rest of the market. So
Yeah.
what David's saying is, if we go and say that the market cap doubles from its all-time highs. I know 6 trillion isn't double, but if it doubles from its all-time high and all that liquidity is only in maybe let's say 100,000 tokens, that is going to be massive market caps for a lot of these strong projects. But sorry, go ahead.
Yeah. Look, I agree 100%. And so we're talking about what we're doing here is we're speculating on during the next bull cycle, when we see a return to a growth phase for these digital assets and they start soaking up more liquidity, and we see total crypto market cap return to its all-time highs at 4.25 trillion and exceed its all-time highs, which I think should be the expectation. Well, then, if we see total crypto market cap run up to $6.25 trillion by 2029 or 2030, well, which projects are likely to see the majority of those inflows? Which projects, which coins are likely to outperform everything else? And let's bring it back to coin market cap real quick. So if we see a massive expansion, and $1 trillion is almost an incomprehensibly large figure, difficult for me to wrap my brain around just how big that is. So if we're here's Hype sitting at 16 billion market cap right now. If we see during that next bull phase, if we see total crypto market cap run up to $6 trillion, well, then I think it's reasonable to think that as long as everything continues down the right path, where we see continued user growth on Hyperliquid layer 1, we see continued transaction volumes that generate revenues, and we see those revenues continue to accrue to the token, I think it makes sense to think that the Hype token could go from a $16 billion market cap to, I don't know, 5x that. Maybe we see it up around 70 or something like that. That would put it on par with BNB right now.
Well, and like you said, though, it's all dependent on people wanting to use the hype platform. If so, what is it? No Hype made a comment here back. Is this it?
I see you guys are chatting about XRP, man. Oh,
yeah. It says, I'm wondering what is going to keep another chain. I think he means like another DEX or platform in a couple of years from being the next Hype. I just feel like it's a dishonest game, and I get where he's coming from, because it's like kind of what's the flavor of the month. But I really think that some of these projects are going to end up being, and that's what we're trying to do here, is identify those. But you kind of have some that just build the reputation, and they tend to attract the big money. Aave is one of those. Even with their whole debacle, they lost a lot of TVL, but they're still doing banging business. Uniswap. We're seeing Aerodrome starting to become a player. Morpho. Morpho is a big one. I'd love to see the tokenomics and the value capture on that token improve, or at least a way to freaking earn with a token. But you can't argue with what Morpho's doing with the vaults, and their superior architecture.
True. And so what I like to do is compare apples to apples. So if we're talking about the Hype token, the Hype protocol, it's a perps DEX. Well, we should probably compare the Hype token, seeing as how that's a token for a perps DEX. We might want to compare that to another perps DEX token, like Lighter with the Lit token, or Jupiter with the JUP token. And so I know that we ran deep dive research on JUP and LIT. And so I'm just taking a look at the market cap for Lighter right now, sitting at let's call it $620 million, significantly smaller than Hype's current market cap at $16 billion. So, we're talking about like nearly an 18x difference between the Lighter token market cap and Hyperliquid's token market cap. So what that tells me is, if Lighter is able to see massive continued user growth, And if those users continue to drive more revenues, and if those revenues accrue to the LIT token, well, then maybe Lighter, even after it's run, maybe it's still an interesting opportunity. So it just really comes down to that value capture mechanism. And in the deep dive research, Mike, that we ran recently on Lighter, and I can hop on in here into the Intel library and hop into the search and type in LIT. And let's see here. Let me see if I need to make this search better. Lighter. So there it is. Here's our deep dive research on Lighter. And if we just take a look at this, and I'm going to go ahead and search for unlock in the documents here. Unlock, the insider unlock cliff. So let's see here. Bullish catalysts, structural risks. So this is really important. This is why our deep dive research is so valuable. Because take a look at this. If you want to learn about the token that you hold and its tokenomics, hop into the Intel library. Take a look at the deep dive research.
It's all free. Like
it's all free.
If you're new to the channel or you see this, and the Node.pro, the DeFi University. If you want to learn about DeFi and crypto and all that, traditional banks, all free. Just go to the Node.pro, make an account so it can keep track of where you're at in your progress, and it's all free. No credit card, no nothing. And the deep dive library David's showing right now, all free. So we're not shilling anything here. We're just trying to help you out. Go ahead.
And so this is what you said is super important, because we've seen just recently a lot of our competing channels, they're launching paid services where people pay for a community. People pay for educational content. We give away superior educational content. There's no reason to pay for education. There's no reason at all. We give it away for free here at the Node.pro. But bringing it back to the Intel library and Lighter. So if I'm going to speculate that Lighter is going to continue to perform very well into the future, well, I've got to understand the risks. I've got to go in eyes open. And the way to do that is to learn everything that you possibly can about the tokenomics for the LIT token. Now, even though LIT has been performing extremely well as of recently, if I bring up LIT USDT, so this is just let me zoom in from the weekly to the daily. So this is the price performance of the LIT token. It's done exceptionally well. The problem here is that there is a massive unlock cliff starting at the end of this year. And the way that I know that is because in our deep dive research, there it is. So yeah, you got to be aware of this, right? So in 2027, there's going to be a massive monthly insider unlock. It starts on December 31st of this year. So that unlock cliff, if trading volumes do not scale proportionally, then you should expect to start getting massively diluted on your LIT token holdings.
And that could cause sell pressure.
It could. So just keep that in mind. I have no vested interest in Lighter. Lighter is not paying us to talk about Lighter. We don't receive money from any protocol, any project, any coin. We don't accept money from interviews.
If we do interviews, we are not compensated in any way. And what that allows us to do is ask whatever questions. We can ask those probing questions that a lot of other people don't ask.
See what Wispy said in the chat.
But it's a lot of people, they do fluff pieces when they do interviews. They just do fluff pieces and just ask nothing but bullish questions. You can watch our interviews. We ask the hard questions. We've had some people on. We always use OPNet as an example. There were some people accusing them of doing some rug pulls, and we told them before they came on. We're not looking for gotcha moments. We told them before they came on, like, listen, we did some digging, and there's some people saying that there was some rug pulls, and there was some questionable stuff, and we just want to let you know that if you come on, we're going to ask you about this, and we expect we just want you to be ready so that you can give your side of the story. And he was like, no problem at all. And I was,
and you're right. And to his credit, the gentleman who came on, who we interviewed, we held his feet to the fire.
Yeah.
And we asked him, hey man, you got to explain what happened with all this. And
He
he
took
did.
like 15, 20 minutes and just
He
got
did.
into detail and explained it all. So
So
that's what not taking payment, does. There's a lot of people out there traditionally that just to mention a project on their show, they would charge like 10, like that Bit Boy, his sheet. He had like a sheet that got leaked, and it was like $10,000 to mention the project on the show. I mean,
and
it
how
just
many
was,
other channels do stuff like
yeah.
that? We've seen so many that have these massive hidden conflicts of interest.
Oh
We
shit,
don't have
we
any
got
of
we
that.
got off topic. Let's get back to this. Sorry.
Awesome. Yeah, let's do it.
So no,
It's,
you
it's,
were
re-
talking
it's really,
about
it's
the unlock on.
yeah. So, the unlock cliff for the LIT token, that starts Jan 1 of 2027. So all I'm trying to do here is, speculate on which tokens or protocols that are competing with Hyperliquid could start to perform like the Hype token. So that makes me think, okay, I'm going to think Lit. I'm going to think Jupe. I'm going to think, okay, what other perps DEX tokens out there that have solid user growth, where those users are driving real revenues, and those revenues are accruing to token holders in some way, where that satisfies our trifecta. Which perps DEX tokens are likely to perform well? That's what I'm thinking about. Now, Mike, with the launch of the Robinhood chain, and we ran deep dive research on the Robinhood chain earlier this week. So if you want to hop into the Intel library and type in Robinhood and scroll down here, there it is, Robinhood chain. If you take a look at this deep dive research, this is extremely good deep dive research. What I'm thinking about here now is which perps dexes are native to Robinhood chain. What perps dex is a native Robinhood perps dex? I'm curious about that because I'm unaware of a native Robinhood perps dex. Now, the way that we could find that is by hopping on over here to DeFi Llama, and we would click on chains. And then from chains, we would scroll down here, and we're looking for Robinhood. We're looking for the Robinhood chain. There it is. So Robinhood has $200 million in DeFi TVL. The 1 week change in TVL is plus 160%. And so if we just take a look at this, not a whole lot of data here. This is a brand new chain, but these numbers look phenomenally good. So if we scroll down here, what I'm looking for next is, you see where it says category here on DeFi Llama? Let me just go ahead and zoom in a little bit so we can see this more clearly. So what I'm looking for here is, and I'll zoom out just a little bit. What I'm looking for is where it's going to say in category, it's going to say derivatives. So when you see derivatives, typically that means perps DEX. So I'm looking for a derivatives protocol on the Robinhood chain where it says it is on one chain. If you see, like for example, Uniswap, this is a liquidity provision decentralized exchange. The category is DEXs here on DeFi Llama. If it says more than one chain, that means that it is not native to the chain that you're analyzing. So for example, if I wanted to look at a liquidity provision DEX that is native to Robinhood, well, then I would be looking at something like SwapHood, because I can see here that it says one chain. So that tells me that it is native to Robinhood. So what I'm looking for then is a derivatives protocol, a perps DEX.
Couldn't other ones be native to Robinhood, but just be on other chains as well?
Yes, they could be native to Robinhood.
That's just a quick, easy way to know the ones that are just on the Robinhood chain.
Yes, exactly. Okay. And also, since this chain just launched, I'd be willing to bet that if there is a perps DEX on here, it's going to be native to Robinhood. Okay. But I don't see any. And you see the TVL here? As I'm scrolling down through the TVL, when you get down here to whatever gamified mining is, this SLVR protocol, it's only got $45,000 in TVL. So this is a brand new chain, this Robinhood chain. And so there are very few native protocols on here right now.
So Mike Bennett, welcome to the show, says Grok says Lighter has Robinhood chain.
Correct, but Lighter is not Robinhood chain native.
Yeah.
So that's the thing that I'm looking for. And the reason why I'm looking for that is when you see a new chain launch, and I'm using the base chain as an example, when the base chain launched in August of 2023,
well, like Alien Base. You talked about alien
Exactly.
base.
Exactly. And so the way that you can find those tokens easily is over here on Dex Screener. So I'm looking right now on the base chain and I'm sorting by market cap. And so it looks like, according to Dex Screener data, it looks like the Morpho token is the largest base chain native token by market cap. So with a $1.32 billion market cap, the second largest token, according to Dex Screener data on the base chain, is Venice, VVV, Venice AI. And then you've got Arrow. So that's what this looks like to me. Although, remember, these are Dex Screener data. So that does not make these like, this isn't exactly the gold standard of data, if I want to put it that way. So if I'm looking for coins, protocol coins that are native to Robinhood, well, I can do that over here on Dex Screener simply by clicking on the Robinhood chain, sorting by market cap, and scrolling down. That's how we found the index token the other day that we ran deep dive research on. So index looks like it is one of the largest coins native to the Robinhood chain. And after we ran that deep dive research, Mike, the other day on the index, I'm just not convinced that you need that complicated tokenomics strategy to get exposure to tokenized equities on Robinhood.
It was interesting. It's getting a lot of mind share. It's had quite the pullback, but it's definitely. I'll be interested to see how it performs. I would tend to agree with you though, because I just don't see where there's any benefit from jumping through all those hoops to get exposure to those those RWAs. Because those that didn't watch that show, I mean, feel free to go and watch it or look at the deep dive research on the Node.pro. But the long and short of it is that you buy this index token and then they take a portion of that and they invest it in this bundle of stocks, like Nvidia and Tesla and a bunch of like the big the Magnificent Seven and a bunch of other big stocks equally, and then like that generates a yield. But there's a lot of flaws that we found in it, to where you would just be better just to go and buy the tokenized stocks directly on someplace like Robinhood or wherever else that you can get a hold of them, and just hold those assets directly and custody them yourself and not have exposure to that volatile index token. But
So according to our deep dive research on the index protocol, which is native to the Robinhood chain, what we learned is that when you take your ETH and you deposit it into that liquidity pool, that Uniswap V4 liquidity pool, what you're doing is you're gaining exposure to the index token. And then 3% of the swap fees from that pool are used to purchase tokenized equities. You can then take those tokenized equities and send them to your DeFi wallet. That's pretty cool. But why would you want to go through the rigmarole of depositing ETH into a liquidity pool and getting a small fraction that's used to swap into a basket of tokenized equities when you could just take your ETH and buy those tokenized equities yourself? Well, the reason why you might want to use the index protocol is if the index token is performing extremely well. So this is the index token. And hey, look, I got to say, I'm going to give credit where credit is due. On the 13th of July, this thing was trading for 0.2 of a penny. As of right now, it's trading for 1.4 pennies. So 1.4 cents today. That is a massive price appreciation just over the last couple of sessions. So this has obviously performed extremely well. But remember, you've got impermanent loss when you take your ETH and deposit it into a Uniswap V4 liquidity pool. So that impermanent loss on the way up, you would have likely done better by just buying the index token itself, if you want to speculate on price appreciation for the index token. So you just got to understand what impermanent loss is. However, since the index token has been performing extremely well, it could actually make sense to hold a position in that index wrapped ETH pool on the index protocol and get some exposure to tokenized equities.
David, Mike Bennett, he shouted out a couple of these tokens. Since you got the chart pulled up, let's take a look at these. So it looks like that they're probably Robinhood projects as well. Up Swaphood, Sheriff, and Aeon.
Yes. So here's Swaphood. So let's take a look at Swaphood. So it says it's a meta DEX. So this looks to me, just at first glance, when I see these tabs up top, dashboard, swap, pool, farm, launchpad, that tells me that this is a liquidity provision DEX.
Yeah.
So let's take a look at pool. So when we take a look at pool here, okay, so it looks like you can supply liquidity in V2. So V2 is full range. So that means that if you jump into this pool with 1 ETH, half of that ETH, 0.5 ETH, will be swapped for HOOD token. If you provide liquidity in a V3 pool, then you're going to be concentrating your liquidity within a range. So you're going to say, I think that price will remain between this level on the downside and this level on the upside. And when you do that, you concentrate your liquidity. Now, what that does is it magnifies the fees that you earn by up to 3,000x compared to
doesn't
V2.
It also accelerate the impermanent loss?
It does. So it magnifies the fees. It also magnifies your gamma. Your gamma is your impermanent loss. That's your cost of volatility. So there's a trade-off. You earn a hell of a lot more in fees. You've also got a hell of a lot more impermanent loss risk there. So this is a liquidity provision DEX. Now, if I take a look at Launchpad here, and let's see here, what's trending on this? So tiny market cap coins on this HOOD. This is HOOD. This is the HOOD. What is it called again? This DEX here, Swaphood. So what I'm looking for now, Mike, is what is the native coin for Swaphood? Is it?
I think it's HOOD.
It's HOOD. Okay. So let's bring it on back then to
that's what you were swapping into with the ETH.
Yeah. So let's see if we can find the HOOD coin. So I'm just scrolling down here through DEX Screener, and I'm looking for that HOOD coin. So I can't find it. Let me just type in HOOD. HOOD. Okay,
that's
so
the second one. Yeah,
this one. Swaphood. Okay, let's take a look at this thing.
Oh.
Okay. So this doesn't surprise me. Okay, so this is what DEX protocol tokens look like when they are used as a reward token. They are extremely inflationary. And the reason why they're so inflationary is to provide rewards to LPs. So if I'm an LP, I take some ETH, I deposit it into a V2 pool on Swaphood, I earn, I'm assuming, HOOD as a reward.
And isn't that what's referred to as a flywheel?
In reverse.
Yeah. But isn't that kind of that flywheel model, that VE, that VE33 model?
Not quite, not necessarily. So you can have a reward token without using the VE33 tokenomics.
Yeah. But that's kind of the model.
Kind of, sort of. So what I see here is just a typical chart for a reward token, a highly inflationary reward token. That's what I see here. But also, and this reminds me of Alien Base a little bit. Take a look at this shit, man. This is crazy. So where the current mark price is, let's call it it's $3.80. So I'm just going to mark it right there and measure. That was an 800% pump. This is a 15-minute chart. So this is the 14th of July. This is 2 days ago. So over the course of just a couple of hours, this thing ran 800%. That's an 8x. That's an 8-bagger. So the thing that's so amazing, in like 2 hours, So here's the thing with these protocol coins that launch on new chains is that even if the tokenomics are garbage, you can still speculate on this stuff and do phenomenally well because there are so few.
Well, and we keep pointing that out. We're very, we keep pounding about, and going on and on about value capture. You need to understand that we're not saying that you can't make money speculating. There is, endless data showing that you can make money in crypto speculating, but that's short term. That's, if you're speculating, chances are, you want to catch things like this. You want to catch, short term hype. You want to catch, short-term, mind share, social media surges, buy the rumor, sell the news, those sorts of things. But if you have more of a risk-off mentality, or you want less risk, I'll say, in crypto, and you don't have the time to stay glued to a monitor and monitor the mind share and the volumes and the things like that, you the best way to do that as of right now that I've found is to look for these projects that have solid value capture.
Right. Yeah, 100%. Big difference between larger market cap coins that satisfy our trifecta that we think are solid long-term plays and speculating on something like the swap hood coin or the swap hood token, which is just it looks like a reward token for a liquidity provision DEX on the Robinhood chain. Big difference between those two things. The reason why this is so interesting to me, though, is when the base chain launched, you saw the exact same thing play out. There were all sorts of different protocols that launched that were base chain native, that had their own coin, their own token, and those tokens were extremely volatile. But that volatility meant that you could perform extremely well by, speculating on price appreciation for maybe a couple of hours. So, yeah, this is interesting to me. And there were a handful of others. I know that we're going to move on over into the deep dive research now. But
let's move over to the deep dives.
Yeah. So, thanks for the comments, everyone in the chat. Maybe once we're done with the deep dives, we can bring it on back to, taking a look at some of those Robinhood chain native protocol coins. Okay.
Well, and while David's bringing up the deep dive for Hecto or Arbitrum, if you could, if you're finding any of this valuable, you're entertaining, whatever, if you could, doesn't cost anything. Go to the bottom, give us a thumbs up, give us a like, and subscribe if you want to catch our live shows. We do this Monday through Friday, 9 a.m. to 11 a.m. Pacific, noon to 2 Eastern, and we have multiple live shows. So if you find this valuable, give us a like, give us a follow, and share it out.
And make sure to hop on over to the node.pro and jump into the Intel library. All of our deep dive research is free. We give this away. Our community, the source room, this is free. We give this away. And all of the DeFi University educational courses, this is all free. We give this stuff away. This is the best crypto and DeFi education in the English language. And guess what? It doesn't cost you a penny. So it's really up to you. How bad do you want it? Do you want to build a crypto and DeFi skill set? Because if you do, you can do that for free. There's no reason at all to pay for any of this stuff. So jump on over here to the node.pro. Let's take a look in that Intel library, Mike. Which one do you want to start off with today?
Let's start with Arbitrum.
Awesome. So Arbitrum, man, I really like the Arbitrum chain, one of my favorite chains to operate on. And I'm just going to go ahead and I'm going to share this piece of deep dive research in the in our community, the source room, real quick. I'm just going to let everyone know that we're running through this research. We are running through this live. Awesome. So I just posted in our source room community, and we're going to go ahead and play this piece of video content. Let's learn about Arbitrum.
By 2026, the Layer 2 scaling landscape divided. High-performance execution networks separated from application-specific rollups. In this environment, the Arbitrum ecosystem matured into the primary liquidity and decentralized finance settlement layer for enterprise applications. That institutional strategy accelerated on July 1, 2026, when traditional finance moved directly onto Arbitrum's customizable Orbit stack with the launch of the Robinhood chain. Built for retail finance, the permissionless network secured immediate traction. In its first week alone, the Robinhood chain processed over 7.6 million daily transactions and cleared $3.1 billion in decentralized exchange volume. This split-screen chart illustrates the financial reality of that network scale. On the left, Arbitrum's fee generation engine executes perfectly, accumulating a base profit run rate of $23.49 million. But on the right, the network's native ARB token trades at a historic low of just over 7 cents. The protocol generates massive, consistent cash flow, while the protocol's governance token bleeds market value. To understand this contradiction, We have to map the exact technical routing of Arbitrum's cash flows and expose the architectural design that deliberately isolates the governance token from the network's execution layer. Ecosystem scale does not automatically translate to token holder value unless the technical architecture explicitly links them together.
Man, Mike, how many times have we been talking about that here on the channel? Like every single day. This is the thing to look out for.
The disconnect starts at the base execution layer. In January 2026, Arbitrum activated the ARB-OS 51 DIA upgrade, completely replacing its single blended opcode gas metric with a dynamic pricing engine. DIA processes a single user transaction through the state transition function. The transaction splits across 4 hardware pathways: compute, storage access, storage growth, and history growth. By tracking these metrics individually, the network adjusts fees dynamically based on hardware bottlenecks, maximizing execution efficiency. Those distinct data streams then feed into a base fee control loop. The system uses 6 different target window pairs, allowing fast windows to immediately absorb short-term demand bursts, while slow windows carefully enforce the network's long-term data constraints. This highly optimized execution engine guarantees that the sequencer captures a 97% gross profit margin on user transactions. Users pay those fees in Ether,
But,
and that Ether flows directly to the DAO treasury. Beyond baseline
but where do those fees go? That's the question. And that's what value capture is. Arbitrum could, and I'm not. I'll be honest, I don't know yet, but Arbitrum can make huge amounts of money, the chain itself. But as if we, the token holders, if there's nothing in the tokenomics where there's a buyback and burn, or some mechanism that makes the token deflationary, or there's some way to where those fees are shared with us, the token holder, then any price movement is pure speculation, and we're kind of seeing that in the charts. I'm looking at the ARB charts right now, and like it was saying, is the all-time highs are around $2.40, and we're currently sitting at around like 6 or 8 cents. So that's a massive pullback. If you bought the all-time highs, you are hurting right now.
Now, I do have to say, and I just want to refresh everyone's memory on the ARB token just real quick. So this is the price action for the ARB token. This is the chart. This is data. These are all the data that I've got going back to actually my birthday back in 2023. So this is really interesting here. This is a beautiful falling wedge pattern. This is a very bullish price action pattern. However, we haven't gotten any pump. This is just a technical breakout from this falling wedge pattern. So usually a falling wedge is pretty darn bullish. Let's go ahead and bring it back to the deep dive research.
execution, the protocol actively extracts capital through transaction ordering. Originally, Arbitrum used an off-chain auction system called Time Boost. Because the custom tooling concentrated participation into the hands of just 3 major trading entities, the DAO deprecated it in favor of priority gas auctions. Priority gas auctions operate at the transaction level. Searchers and users specify a priority fee natively in their transaction payload to secure block inclusion. The protocol extracts this maximal extractable value margin entirely in Ether, routing it straight to the DAO treasury. Under the Arbitrum expansion program, enterprise networks deploying custom orbit chains, like the Robinhood chain, forward a 10% cut of net protocol revenue to a fee router. It automatically divides the capital, 8% to the DAO treasury and 2% to core developers. Because this license fee is calculated from net revenue rather than gross fees, the taxation model remains sustainable by accounting for underlying Layer 1 and Layer 2 settlement costs. Every major infrastructure upgrade, from dynamic gas pricing to orbit licensing, is engineered to route millions of dollars in Ether into a centralized treasury address. The native ARB token is entirely bypassed in the process.
Oh, yuck. That's horrible.
Not good.
So
that kind of explains the token.
it really does. So this is what we're always looking for. Okay, so there's user adoption, there's user growth, there's significant revenues that are generated, but those revenues bypass the ARB token entirely. So what exactly are you holding if you hold that ARB token? It looks like you're just holding some type of governance DAO token. Yuck.
The token is also excluded from network security.
Ah,
Arbitrum relies on a permissionless dispute protocol called BOLD, allowing any single validator to defend the network state natively on Ethereum Layer 1. This decision tree compares validator bonding assets, ARB or wrapped ether. Using ARB invites reflexive attacks. An adversary's invalid claims drive down ARB's price, making it cheaper to mint more bonds and indefinitely spam Layer 1. Utilizing wrapped ether completely neutralizes this loop. WETH connects the dispute directly to the settlement layer, with an asset whose valuation is structurally independent of the Arbitrum internal state. This risk is so severe, the Arbitrum Foundation capitalized the first bold validator using 5,134 ETH from its holdings, entirely avoiding its native asset. Securing a mature Layer 2 intrinsically demands excluding its highly volatile governance token from the validation consensus mechanism. While the Treasury hoards Ether, the
Real quick,
supply mechanic.
I want to point this out because Arbitrum, like the project, very bullish on it. I mean, there's a lot going on with it. Same can be said for Ondo. Ondo Finance and Ondo the company is doing bang up business. But again, a governance token. They're just we're seeing this repeat over and over. And there's a separation between the success of the company and tokens that lack value capture, like governance tokens, where they're not scaling proportionally, they're not correlated. You're seeing the use and the fees and the revenue generated by the underlying companies grow and their success grow, their adoption grow, but you're not seeing the token value grow with it. That is the disconnect. The disconnect that we've identified that seems to be holding, we're seeing a lot of data that validates it, is that tokens like Hype, tokens like Tron, tokens like BNB, and other tokens with value capture are outperforming the overall market and Bitcoin. We've
yes.
repeatedly shown the charts to support that. So it's so important that you check out these deep dives and do your own research, because this is potentially what is going to set apart those that profit during this next bull market and those that don't.
I agree 100%. And I just want to make another point about governance tokens real quick. So, I think that we might be entering an era where governance tokens, just kind of get deprecated, and we stop seeing so many governance tokens launch, and we stop seeing DAOs that are centralized. So here's something to keep in mind. There's a DAO, so ENS. This is the Ethereum Name Service DAO. Mm-hmm. And so this token, the Ethereum Name Service token, it trades at a 50% discount to its underlying net asset value. So my understanding here is that ENS, the DAO, and the ENS token governs the DAO, that the ENS DAO has like $400 million of ETH in it. But the market cap for the ENS token is half that. And so what that tells me is people don't believe that the ENS token is worth the underlying assets in the DAO. That's not good. So there's a lot of these governance DAO tokens that, exactly what is the point of a DAO token if it's concentrated, if the ownership is concentrated in a handful of wallets, then it's really not a decentralized autonomous organization. It's much more like a centralized autonomous organization where a bunch of a handful of token holders basically maintain and drive the entire DAO. So this ARB token, what's the point of the ARB token? That's the question. Why hold ARB? If the Arbitrum chain is driving all these revenues and we're seeing all this user adoption, but it completely bypasses the ARB token, those revenues bypass the ARB token, then what exactly are you holding if you hold ARB?
Mechanics of the ARB token actively penalize the market. This graphic tracks the protocol's linear unlock schedule, initiated after the March 2024 cliff. On the 16th of every single month, the contract releases roughly 92.65 million ARB tokens into active circulation. That mechanism injects 1.65% of the active supply to core contributors and early backers every 30 days.
Oh, that is horrible. Think about that inflation rate. If it's inflating away at nearly 1.7% per month, and all the revenues that the Arbitrum protocol generates don't accrue to the ARB token, then what's the point of the ARB token for token holders anyway? I can't figure it out.
I can tell you what it's what it's good for the the Arbitrum Foundation, or for the company, because historically, I mean, that's what we've seen with a lot of these crypto projects is retail. We've been investing, speculative investing, and some of us have made some money, but for the most part, it's bootstrap liquidity for them to build these projects, these products and these services. And there's no guarantee of us making money other than those speculative pumps.
So do your own research, hop into the Intel library, and don't be the exit liquidity for some protocol that is trying to bootstrap.
Establishing a massive, permanent baseline of sell pressure. Against this dilution, the Arbitrum Foundation submitted a budget request of roughly $45 million to cover operations for 2027. The protocol generates $23.49 million in annual base profit. Operating at $45 million creates an immense mathematical deficit.
Yeah, how do they fund that deficit? By inflating away the token by 1.7% per month, selling it on the open market, and using the proceeds to fund the continued development of Arbitrum. So you don't want to hold this thing with these tokenomics right now.
Because the Treasury prefers to hold its collected profits in Ether and real-world assets, the Foundation funds this operating deficit primarily by selling portions of its locked ARB allocations onto the market. Retail token holders absorb the financial cost of ecosystem expansion.
Do you see that? That's exactly what we just said.
Yeah.
Retail token holders absorb that cost. You get no value accrual if you're holding ARB. So what's the point? Don't hold it,
I mean, if you're a trader and there's some big news and you think that there's going to be a pump and you want to long it, or if you think there's going to be a dump and you want to short it, I mean, yeah, there's ways that you can make money off any token, off anything that you can trade. It's the same thing with baseball cards. If you think that buying a baseball card over time is going to be a good investment because somebody down the road is going to buy it from you for more than you bought it for, then yeah, I mean, you can make money on it. What is that baseball card actually worth, though? I mean, that could be argued, but that's kind of what we're trying to point out here, is that if there isn't a way that you, the token holder, can extract value by holding the token, you really need to ask yourself, why invest in that token? And that's what it comes down to: is, are you a trader? Are you a long-term investor? Are you do you enjoy less risk or more risk? How much of your portfolio, what's your sizing, your position that you want to take in that, based off of all these variables? Those are the questions you have to ask yourself when investing in these assets.
And the only way that you can, really get to good information is by hopping into the Intel library, I think, and running through the deep dive research. You've got to understand what it is that you're holding. That's the important thing. It's okay to speculate. You can make money speculating 100%, but you've got to go in eyes open. You've got to know what it is that you're holding in your portfolio.
As long as you understand what you're investing in and you understand the risks and stuff, that's all we're trying to do here. We're not trying to tell you what to buy and what not to buy. We're just trying to educate you on these assets, get you started, with things like these deep dives. You do your own research, and after all that, you decide. It's your money. I couldn't care less what you invest in, and David doesn't either. It benefits us in no way whatsoever.
Look, I'm an algorithmic trader.
Yeah,
we don't get paid from any project ever. No. And so that means that we can put out what we think to be the truth. We seek truth. There is such a thing as objective truth.
And something I want to point out is, on these deep dives, if you scroll down to the bottom, on the Node.pro, there's the last document. It's called the source document. If you scroll to the end of that, there's usually like 2 or 3 pages of nothing but hyperlinks. So like if you've been to college, you know what I'm talking about. They're called cited sources. That means that all the information that we built all of this off of, We cite our sources. So you can go and verify if you want. And if you feel like at any time that we got anything wrong in doing these, message us on the Node.pro. We are more than happy and cite your source showing that we're wrong. And we are more than happy to make adjustments. We're not here to FUD any projects. We're not here to hype any projects. We're here to educate you on these projects and to educate ourselves in many cases.
Exactly. We learn right along with you guys. This is so much fun to be able to do this every day. And Mike Bennett in the chat, man, I really appreciate that comment. You know, it's rare to hear these words on a crypto channel. This is good stuff. We are learning with you. And, you know, we don't get compensated from this. So this is just a learning opportunity for us too.
Hey, Jeff, not in my high school, brother. I went to one of those alternative high schools. So they were just happy if we showed up.
Economically, the fix is straightforward. Programmatically route a percentage of the $23 million protocol profit back to ARB token holders to offset the dilution.
Okay, so this is how Arbitrum could fix the broken tokenomics of the ARB token. But will they ever do this?
And that's the key. I will say this. We are seeing some projects making adjustments like Uniswap, where they made adjustments to
fee switch. The fee switch, yeah.
They added utility, and there's others. They added utility to their token to add value capture. We've heard rumors that Ondo potentially, towards the end of this year, there's supposed to be a vote where potentially they're going to add utility to the token. If that happens and what that looks like, no idea. But so we're not saying that these tokens, the value capture and things like that, that they're going to stay like this forever. We just like to state the facts as they are currently. And again, we'll try to stay on top of it, but there's 54 million projects. We're not going to be able to stay on top of them all. That's why we love all of you being in the chat and educating us, getting on the Node.pro, get into our community and sharing with us, alpha, so that we can go and verify it. Please, as always, cite your source and we'll happily put it on the show. I can't stress it enough. We are here to learn and we are here to educate. And we count on our community to help us with that.
And we give it all away.
This schematic illustrates the legal barrier preventing that solution. The DAO Treasury sits behind a regulatory firewall enforced by the SEC's Howey test.
Oh, yuck. So they can't actually distribute revenues to token holders in that way.
Implementing an automated revenue sharing mechanism derived from sequencer efforts would instantly classify ARB as an investment contract. That classification would require strict securities registration and destroy the token's global liquidity and decentralized finance composability.
Okay, so Mike, that's the attach part of the SEC's attach-detach framework. So if there were a governance change for the ARB token and revenues were somehow streamed back to the ARB token holders, then suddenly ARB would become a security. They can't do that. So what does that mean for ARB token holders?
These projects can't pay dividends.
Right.
Unable to distribute the capital, the DAO instead diverts funds into the Stable Treasury Endowment Program to prevent the cash from sitting idle. Allocating millions to tokenized U.S. Treasuries generates sustainable, uncorrelated yield. But that wealth remains permanently trapped behind the regulatory firewall, entirely inaccessible to the token holders actively governing it.
Not good.
To address severe governance fatigue and protect the Treasury from hostile takeover vulnerabilities, the community advanced a proposal to implement native ARB staking. The system requires active participation. To qualify for yield, stakers must delegate their voting power to an active delegate.
Okay, so this is important too, because this, the legislation as it stands now, the Genius Act, it says that you can earn yield, but you have to be performing some type of activity. And that yield is referred to as, quote, a reward. So it's not a dividend. A dividend would make it a security. But by performing an action, then you're able to earn a, quote, reward. So the legalese here is important.
And that delegate must maintain an on-chain participation score of 75 or higher. This flowchart maps the architecture. Users deposit ARB into a staking contract. In return, they receive SARB, a liquid staking token that can be deployed across external DeFi protocols, while their voting power is routed to an active delegate. But the economic reality of the yield reveals a critical limitation. To avoid securities classification, the protocol fee switch remains completely disabled. The proposed 8% yield is funded exclusively by minting 100 million new ARB tokens annually.
Oh, yuck. So they're funding the yield by diluting the token. That's horrible.
That's counterproductive.
Well, that explains the price action of the coin, of the token. Yeah.
The current staking model creates utility through dilution-funded yield.
Ugh,
It fails to bridge the gap between the token and actual protocol cash flows.
right.
To transition ARB from a purely speculative governance share into an asset with direct economic value, the network must clear specific structural milestones. This network map outlines the first technical catalyst, decentralized sequencer staking. It maps a future state where centralized sequencers are replaced by a distributed node network. By forcing node operators to stake a minimum allocation of ARB as collateral to secure their sequencing rights, the protocol establishes direct, organic demand for the token that doesn't trigger dividend restrictions. The second catalyst is integrating enshrined proposer-builder separation at the Layer 2 level. Implementing this architecture would allow block builders to bid for transaction inclusion rights directly in ARB. This mechanism creates a continuous, organic token sink operating inside the block construction process itself. Until Arbitrum alters its consensus mechanics or its block building architecture, its governance token will remain exactly what it is today, an isolated observer to the network's massive financial success.
Oh, man. So ARB is an isolated observer to the network's financial success. So what are you doing when you hold ARB? You're holding something that is very inflationary with no value capture. No, thank you. All righty. So, man, that was a great piece of deep dive research.
So real quick, if you're watching over on X, jump on over to YouTube and join the chat. I would love to hear what some of you have to say and answer some of your questions. So I dropped the link in there, but if you want to find us, we're at the Node Network, all one word. Super easy.
Super easy, man. And let's see here. So we just ran through that piece of deep dive research on Arbitrum. What are you thinking next, Mike? Hecto or Hecto? Alrighty. So what is Hecto? What is this? I don't know.
Yeah, let's check it out.
Let's check it out.
In 2013, just 39 private unicorns existed. By 2026, over 1,500 private enterprises hold a collective valuation exceeding $8.6 trillion. Because companies remain private far longer, most enterprise value creation happens before an IPO. Retail investors are effectively locked out. The mechanics keeping this capital isolated are structural. Private market asset allocation enforces high investment minimums, opaque price discovery, and highly illiquid secondary markets, where transaction fees erode yield. The Hecto protocol is designed to dismantle these barriers. It operates as a blockchain-native gateway, extracting the value of the pre-IPO economy and routing it directly on-chain. It achieves this by deploying compliant financial instruments natively on the Canton network, leveraging the chain's inherent institutional privacy controls to bypass the limitations of legacy brokerages.
Okay, so this is a Canton native protocol.
This allows capital to bypass the traditional choke points of private equity, executing targeted strikes into a concentrated, previously inaccessible asset class. Solving this lockout requires a unified system. A protocol must be able to bridge raw public sentiment signals directly to compliant on-chain settlement rails without violating strict securities laws. The foundational mechanism of Hecto relies on taking messy, off-chain market intent and mathematically structuring it into settled on-chain capital. This outlines the protocol's 3 processing stages: signal, access, and settlement. In stage 1, Hecto Predictions acts as the front door. Users crowdsource valuation signals for private giants, aggregating disparate inputs into a single price feed. In stage 2, that signal dictates asset routing. Hecto PMX packages these private company valuations into structured token index baskets. Simultaneously, Hecto vaults handle direct, customized deal routing for larger institutional orders. Stage 3 handles the execution. The pipeline relies on the Canton network's native transaction infrastructure, utilizing the CIP56 token standard to guarantee multi-party settlement. To bootstrap the data required for this pipeline, Hecto pushed its live prediction market into production in March of 2026, generating the sentiment signals needed for its valuation models. As capital moves through the access layer, the protocol applies specific onboarding rules. Tokenized index products run on waitlists with standard verification, while direct asset onboarding and credit through the vaults utilize rigorous quote-based workflows. This three-step sequence allows the protocol to filter raw sentiment into structured data and regulatory containers before it reaches the settlement layer. Without this progression, the system would lack the verification necessary for institutional-grade settlement. Traditional decentralized finance protocols face a specific regulatory trap. When a standard governance token is directly tied to the yield of real-world asset pools, it risks being classified as an unregistered security. Hecto addresses this by implementing a dual token separation framework, physically isolating the governance utility of the protocol from the actual private equity exposure. This flowchart illustrates how Hecto's jurisdiction-aware compliance engine dynamically segregates its user base. Traffic hitting the Canton network interface is filtered into two distinct paths. The institutional KYC path leads to the $HECTX token. This is a passive, non-governance tracking asset. It provides diversified economic exposure to a curated basket of late-stage private equity, optimized for compliance. The retail path leads to the $HECTO token. This is the coordination and incentive layer. It holds no underlying asset backing and is utilized to participate in prediction signaling and protocol voting. To further shield the platform from systemic contagion, the bespoke deals routed through Hectovaults utilize risk-isolated special-purpose cells. Each private market deal is partitioned into an independent smart contract cell. If a single off-chain asset defaults or faces a liquidity crisis, the damage is contained within that cell, leaving the broader protocol and the HEXTX index token untouched. Risk is localized. By hermetically sealing individual credit events, the network prevents failures from chain reacting across the ledger. By combining this cellular structure with a physical separation of the speculative governance engine from the asset token, Hecto isolates its ecosystem from common securities classifications. The dual token model creates an economic challenge. The protocol must incentivize continuous token locking for its prediction market, but it cannot distribute platform revenues directly to those token holders without violating compliance rules. This mathematical formula drives Hecto's soft staking prediction market. Users lock the Hecto governance token to signal conviction regarding private valuations, competing for a total reward pool, our total, denominated in Canton's native gas asset, CC. A successful outcome scales with conviction. A correct predictor receives a payout, RI, that is strictly proportional to their specific stake, SI, relative to the total correctly staked pool, S total. For incorrect predictions, the protocol relies on a no-loss architecture. There is no yield generated, but the exact principal amount of staked Hecto is returned to the user. Their tokens are never slashed. Removing the risk of principal loss shifts user behavior. Participants move away from short-term trading in favor of continuous, multi-cycle locking to capture the gas asset rewards. Because the governance token has a hard-capped maximum supply of 1 billion, this locking cycle reduces the active circulating supply on the open market. The staking contract creates a tightening vacuum. Supply is continuously pulled off the market, locked, returned, and immediately relocked for the next prediction cycle. Distributing yield via a secondary ecosystem gas token while preserving user principal creates a sticky, compliant incentive structure for harvesting off-chain valuation data. The protocol's value capture strategy relies on a closed-loop engine that systematically routes the liquidity events of the traditional private market onto the ledger. The protocol generates revenue through three primary streams: settlement spreads on the prediction market, management fees on the PMX indexes, and origination fees for vault deals. This flow diagram tracks what happens when a private company held within the HECTX index launches an IPO or undergoes a major buyout. The resulting influx of off-chain capital splits into two downstream channels. The first route is C-RE, portfolio reinvestment. A portion of the proceeds is recycled into liquidity provisioning, rebalancing the index pools to maintain the token's exposure to the private economy. The second route is CBB, programmatic buybacks. The remaining capital is routed into an automated smart contract node. These contracts execute market buybacks of the HECTO token, pulling from open liquidity pools to shrink circulating supply. This automated mechanism establishes the direct economic link between the fundamental performance of the private companies and the token ecosystem.
Brilliant.
By linking off-chain IPO liquidity to on-chain deflationary tokenomics, Hecto establishes a sustainable value capture engine that accrues value to its token supply without requiring direct yield emissions. In 2026, capital markets are defined by sustained high interest rates, volatile public equities, and a surging institutional demand for sovereign on-chain privacy. Canton's privacy-preserving ledger provides the base layer for this integration. By hiding counterparties and exact trade sizes from public block explorers, the network provides the conditions institutional asset managers require to deploy capital. Hecto utilizes this infrastructure to structurally separate governance utility from asset exposure, addressing the RWA regulatory trilemma through its dual token design. Every distinct mechanism, the daily sentiment feeds, the risk-isolated vault cells, and the deflationary IPO buybacks, locks together to form a single, unified execution layer. By converting raw speculative valuation signals into structured on-chain data and leveraging that data to execute asset-backed token buybacks, Hecto aligns traditional capital markets with decentralized finance. Hecto provides a mathematically rigorous, compliant blueprint for migrating the multi-trillion-dollar pre-IPO economy onto the blockchain.
Brilliant. Wow. And so as that was running, I went ahead and found the X account for Hecto Inc. So this is at Hecto Inc. And so what I want to do here now is I want to take a look at the actual Hecto protocol itself. So here is...
After you're done with that, I want to take a look at the price chart of the token.
Yeah. So what was that token again? HCTX? Was that the
I thought it was just Hecto, HECTO.
Hecto. I don't know if that's the token. You know how we can find it though? If we scroll down to the bottom, usually there's a documents section here. Okay, there it is. Hecto token. So here's you were right, Hecto. But I can't find it on TradingView. Okay, so it says the participation layer for Hecto. Alrighty, allocate, settle, receive. It says rewards are distributed in CC token, in Canton. Awesome.
Really?
Yeah. So it says here that, I know, right? That's pretty cool. So you use Hecto to allocate across companies in the allocator, determine daily reward eligibility, and receive ecosystem reward distributions. Alrighty. Distribution is live through the allocator. It's got a 1 billion token supply. Alrighty, let's continue scrolling down here. 1 CC equals 100 Hecto. Alrighty, cool. Let's keep going down. Oh, trading's not live yet. Got it. Okay, so it says Hecto is not tradable during the current distribution phase. Trading begins only after an official Hecto listing announcement. Okay, so this is the distribution phase. And the next phase is the trading phase. So that's probably why I couldn't find the Hecto token on TradingView. Okay, so only trust official Hecto sources, of course. Alrighty, this is really interesting, man. Built on Canton. And this is not the only new protocol on Canton with phenomenal tokenomics. I mean, these tokenomics look pretty darn good to me. There are a lot of other protocols over here on Canton that are launching or about to launch. And one of the posts here that I've got brought up on my screen is from the Canton Army. I'm just going to go ahead and I'm going to copy this link. I'm going to bring it on in to our community. We call it the source room. So here's our community. I'm going to go ahead and paste this link in here so that everyone has access to all of the different protocols that are launching on Canton. And we can just take a look at this real quick. So, I mean, there's a lot going on. So we've got capital markets and trading with Temple and Cantex. You've
Well,
got
Camtex,
lending.
we're doing a deep dive on tomorrow.
That's going to be good. That's going to be really interesting. So here's Cantex. Looks like it's cantex.io. And then you've got lending, credit, and yield with Acme Markets, Alpend,
That
Helios.
Alpend has done really well. Scott, that was on the show last Friday, he got early access and made a bunch of free Canton off that. And I'm wanting to say that they're going live soon.
Could be. Yeah, I'm not. Didn't we run deep dive research on Alpend? Did we? Maybe.
Let me take a look.
And then we've got Helios Finance. We've got All DeFi, and we've got EQ Market. All right. And then for DEXs and liquidity provision, yes, we did, right? Alpend. And so for DEXs and liquidity provision on Canton, you've got OneSwap, Tradecraft, Pool Party, Ascar, and Helvet. Okay. And then for derivatives and perps, we've got Raven Markets. We've got Can Borsa. Can Borsa, that rings a bell.
I think that Jeff might have done that one.
I think he did.
Yes,
and
he
then
did. RWA Perps Dex on Canton Network. He did that on July 2nd.
Yeah, so Can Borsa, take a look at that. And then we've got Ekiden. And then we've got another one called Unhedged, and then we've got Rocky Exchange. And then for RWAs and tokenized assets, we've got Edel.finance and then Hecto Inc. We just ran through the deep dive research on Hecto Inc. And then for payments and liquidity infrastructure, you've got EA Finance, Silvana Book, Handle Pay, and Send. So there are all sorts of new protocols launching on Canton. And it looks like a lot of the tokenomics for these protocols launching on Canton are far and away superior to the tokenomics for most protocols when they launch on EVM chains, let's say. So the Canton tokenomics, just as a rule, what I've noticed so far, they seem to be a hell of a lot better. And so what is that burn mint equilibrium looking like there, Mike, for Canton? Because I did see a post that the BME got up to 0.71 right after the DTCC launch of tokenized equities and RWAs on Canton. So what is the website where we'd be able to take a look at that burn mint equilibrium? What's the name? What's that URL for that website?
I'm sorry, I was typing in the chat. What's that?
I'm looking for the website for where we can track the burn mint equilibrium for Canton for CC.
Oh, hold on, let me pull it up. It's probably Canton Scan. There's a couple of them I look at. Yeah, go to Canton Scan.
Okay, so the URL there is cantonscan.com. Okay, cantonscan.com. Canton Blockchain Explorer. Here we go.
And the burn mint ratio is actually going up a little bit, and that could be because of the launch yesterday on where the DTCC started some tokenized RWAs and did a soft launch for tokenized RWAs on Canton Network.
So check it out. The BME is sitting at 0.721.
Yeah.
So that is up significantly from where it was just late last month on June 28th. It was sitting at 0.50. So that burn mint equilibrium, if you just imagine in your mind's eye a level of trend line resistance, well, the burn mint equilibrium has broken out above that level of trend line resistance.
Mm-hmm.
Sitting at 0.72 right now. What happens when it gets to a 1.0? Well, then the token becomes
deflationary.
Deflationary. So that's a big deal for anyone who.
And it is, because we actually have an apples to apples, somewhat an apples to apples as far as tokenomics example of what Hype has done. Hype is same thing. They have that burn mint, and because of the amount of fees that are being generated on the platform, they are able to buy back, programmatic buy back and burn the Hype token, which, because of that volume and those fees being generated, has allowed the Hype token to be deflationary. And potentially that is what has pushed that hype token to outperform the overall market. What we're
And
hoping,
Bitcoin.
and notice the verbiage I'm using, because I don't want you to rush out and buy Canton thinking that it's a guaranteed. I'm going to become a millionaire. That's not what we do here. We are focusing on data, and data suggests that if this does flip inflationary, if it does flip inflationary, it could.
Deflationary. Deflationary.
Excuse me. Yeah, thank you. If it flips deflationary, it could have very positive price appreciation.
I would expect so. My speculation here is that if or when CC becomes deflationary and that burn mint equilibrium reaches a positive number, it gets up to 1.0, then I would expect that the CC token itself would start to perform really, really well. So just like when we were taking a look at the Robinhood chain protocols and those protocol coins, whenever you see a new chain launch, and Canton is relatively new, whenever you see a new chain launch, whether it's the base chain or Robinhood or Canton, and then you see new protocols launch on that chain, if those new protocols have a token and the tokenomics are super solid, they can be phenomenal opportunities. So that's why we're spending so much time taking a look at Canton protocols like Hecto, like Alpend. That's why we're taking a look at some of these Robinhood protocols like HoodSwap, because these new protocol coins on relatively new chains, they can be amazing opportunities. So this looks really interesting to me. I'm happy to see that with the DTCC launch, excuse me, that the BME is moving to the upside. I'm happy to see that.
No, absolutely. No, and full transparency. I mean, it's Canton is my second largest bag. Just because of a lot of it is because of the tokenomics. We've interviewed the one of the co-founders of Digital Asset and the builder of Canton Network, and we spotted this. I don't know of anybody else that spotted it before we did. The day that it popped up on RWA.xyz, I reached out to some other people in the content creator community because when it popped up on RWA.xyz, it had $400 billion of TVL. It bumped Ethereum out of the top spot. And so I reached out and I was just like, hey, have you heard of this? I've never heard of this. And they've been building for over a decade. I'm like, have you ever heard of this project? And they said, no, I haven't. And so I started digging into it and we started covering it. I've only found one channel, and check him out if you get a chance. Let me pull him up real quick. Where is he at?
You're talking about Scott with Longview Compute, right?
Yeah, Longview Compute. So I want to give him a shout out because he's
definitely got a lot of great information about Canton, that's for sure.
Yes.
And I'm taking a look here, Mike, at the CC token price performance. And after we got that launch of DTCC tokenized equities, you did see a really nice pump out of the CC token. You can see that here. Now, where did that pump find resistance? At the 200-day moving average, this white line that's drawn on the chart. So this white moving average, that is the 200-day moving average. That is where CC token found resistance just the other day when DTCC tokenized equities launched on Canton. And we've seen so many posts on X, people talking about XRP or XLM having something to do with this DTCC tokenized RWA launch. And unfortunately, those pieces of information are extremely misleading because we're actually seeing real trading volumes on Canton, not on XRPL or XLM Stellar.
Well, and we brought the receipts on that. I believe it was yesterday. And I've actually been talking on X with quite a few other content creators and some of which have corrected themselves. And I'll give respect where respect is due. having the intellectual, honesty or integrity to, when presented with new information, to reassess and not just dig your heels in. I'd love to give credit for that, because that's what we try to do here. But what we pointed out was that Ripple is involved with it in an advisory role. So it doesn't involve XRP, doesn't involve the XRPL, the chain or the token. They are just advising on how the DTCC can tokenize assets. That's it. As of right now, Stellar, same thing. Now Ripple Prime is acting as the key custodian, so the wallet keys. They're acting as for compliance. They're acting as the key custodian. Again, does not involve the XRP token, does not involve the XRPL. It involves
but there's an important distinction, though. So Ripple and XLM Stellar and Canton. So the DTCC is launching a multi-chain strategy. So if Ripple is the custodian for keys, that is just one leg of the DTCC's tokenization effort. That, I don't believe that has anything to do with the tokenized equities and RWAs trading on Canton.
No,
I think that those are completely separate.
No, absolutely. And so it's important to understand, the details, because if you just, look at social media posts, there's a bunch of them. And I was going through and trying to call all of them out, because I really just want to, make sure that people understand what they're investing in. And again, what you choose to do is totally up to you, but I just want you to do it fully knowing if the information you're doing it with is accurate. So I was going through all yesterday, and just any post I could find where an XRP maxi or an XLM maxi was trying to say, we're going live today, boom, this is it, we're going to the moon, all of that. I was trying to go through and address as many of those as possible. Now XLM, they are slated to potentially have their own pilot project go live H1 of 2027, so the first half of 2027. But there is a bunch of regulatory adjustments they need to make to their, to their chain, so that they can do that. And like David's showing, we did a deep dive on Stellar Network. So again, if you're going to choose to invest in these assets, all that we hope that you do whatever you want to do, but all that we hope that you do is make sure that you do it in an educated way so that you can mitigate your risk. So don't just invest off of social media posts. Those are geared towards your emotions. This is something else we teach in our 100% free DeFi University, is how to keep your emotions in check. Because emotions is what big money uses to manipulate retail to get you to invest in these projects. And as you invest, and as the rest of retail, emotional retail invests, they are extracting liquidity. They are selling into pumps. They are buying into dumps on some projects, because that's what they're doing right now. That was kind of the title of this show, was we wanted to point out that during this down market, institutions are doing nothing but build. They're doing nothing but buying up good, strong, solid projects like Hype that we pointed out earlier in this show. We're seeing them, collecting Canton and building up in Canton. A lot of the validators and super validators, part of the tokenomics is they have to stake, millions and tens of millions of CC tokens to be a validator and a super validator. So, and we're not talking about, mom and pop operations. We're talking about, JP Morgan Chase. We're talking about large institutions and banks that are, launching their own validators and super validators, because they want to say in how the network is run, because they're all building on it. We got the DTCC launching. We got Broadridge that has $400 billion of repo, the repo markets. That's what's generating the majority of the burn mint that David showed.
And
So
so here's that burn mint equilibrium. Now this is in our Intel library, and this is the Canton deep dive research in the Intel library. This is the description of the burn mint equilibrium. So step one, a transaction is initiated. A fee is charged in US dollars. Step two, there's the burn phase. CC is purchased and burned, decreasing supply. And here's stage three, the mint phase.
100% of the fees generated.
That's important to take note of, because a lot of these protocols will, burn a portion of fees, not 100%. So here's stage three, the mint phase. New CC tokens are minted at regular intervals to incentivize infrastructure providers and application builders, increasing supply. We've got to point out the fact that right now CC is inflationary. So even though we really like the tokenomics, it is still inflationary. You got to know that. So, and then stage four, dynamic equilibrium. And that's what we're looking forward to, where the network balances the two to maintain stability. So we're not quite there yet, but that's what we're looking forward to. So this, if you want to learn about the BME, the burn mint equilibrium for Canton, hop into the Intel library. It's free. Just jump on in, take a look through the deep dive research. If you find something that you think is really interesting, then you can go ahead and post it in the source room and we can talk about it. So, I just posted some content in the source room about Canton. If I click to post this in, then I can go ahead and let me just go ahead and paste this in. And I'm going to say Canton BME deep dive research, enter. And so now anyone who's in the community source room can take a look through this Canton deep dive research. Now, if you want to take a look and chat with everyone else here in the Intel library, you can easily do that if you just hop into community here. So from our homepage, this is the official Node.pro website. If you click on where it says community, then you can take a look at all of the deep dive research that we post in here. The Intel library is where all of our deep dive research lives. And if you want to interact with everyone else in the community, we've got a fast growing community in here. So this is the place to go if you want to chat about anything that you learn in the DeFi University, in the Learn tab, or anything that you
pronounce Leering.
The Leering Center.
The Leering
so if you want to hop on over to the Leering Center, well, we've produced all of that DeFi University course material. So whether it's beginner content in the DeFi high school right here, and so I wrote all of this stuff. And if you want to learn about money, okay, most people don't understand what money actually is. If you want to learn about money,
David likes money.
I like money. It's very nice. Yeah, I mean, look, if you want to build a skill set, right, then hop into the DeFi high school in the Learning Center. If you want to improve upon your current crypto or DeFi skill set, hop into the DeFi University here and run through these courses.
All of this is free.
It's all free. It's all free. We give this stuff away. And if after you go through the Intel library and the Learning Center, the DeFi University, the DeFi High School, and then you want to talk about it, jump into the community and we can chat about it. And then if you want to take it a step further, we've got a trial, a 7-day free trial for all of our premium live calls inside the Node.pro. So we've got a couple of different offers here. If you find value in what it is that we do, then you've got an option to potentially hop on live calls with us and we can go back and forth about your positions, whatever it is that you are working on. We can talk about that live during the premium live calls. So that's totally up to you, but we give everything away for free.
That's not just a one-on-one. That's a whole community of individuals that are sharing what they're doing and making money. So it's not just me or David. There's a whole group of people that are doing advanced DeFi strategies, that are investing and trading and doing different stuff. Maybe finding good projects, early projects that they want to share with the community, and they're sharing their mistakes, which is just as valuable. Is what to avoid, what not to do. That's
exactly.
There's massive value in avoiding mistakes because we've all made costly mistakes. I mean, just simply doing test transactions when you're sending, money like between wallets and things like that, to make sure that it gets, that before you send large amounts, that it gets to where you hope that it goes. Because I don't know about any of you, but there's been times where I've done transactions, large transactions, and sometimes the transactions take minutes or longer, and you're sitting there just biting your nails, going, "Please show up, please show up."
Oh man,
Please.
and yeah, no, that reminds me of back in the day, bridging transactions. Those
Yeah,
were always hand wringing. But if you want to avoid making costly mistakes, hop on over to the coaching tab. I'd love to talk to you. I've worked with over 400 private clients in greater than 30 countries over the last 5 years.
mhm.
I've been full time in crypto and DeFi since 2022. Bought my first Bitcoin in 2012. So I've been in this space for 15 years almost. So usually it's about helping someone build a skill set and avoid making costly mistakes.
Absolutely. And the last thing that I'll do before we end this show is, if you could, like, we have a huge amount of people over on X right now watching the show. If you'd like, join us over here on YouTube at the Node Network, all one word. Let me see if I can zoom in a little bit. At the Node Network, all one word. And this is where you can join the chat. So all of us that are over here in asking questions and sharing information, and because that's what all this is about. All of this this is about interacting, having questions, jumping over on the Node.pro and getting in the community, but jump in the chat while we're live. Ask questions, tell us if we're wrong about something. Tell us we're full of shit. Whatever. We don't care. We're here. We don't have egos here. We're all about learning, and we're all about educating. So that's what we're all here for, is to learn and make money. So please jump on over to the Node Network over here on YouTube, and join us. What is it? It's Thursday. So join us tonight for the red pill. Tonight we have the red pill. I need to decide what the red pill, and we have Paulo, who is going to be our host. The old
That's
the
going to be
Velvet
great.
Portuguese, the Velvet
Yes.
voice Portuguese. He's going to be hosting tonight.
It's going to be awesome. Looking forward to that one.
Yeah. So if you haven't noticed, we're kind of based here. So the red pill is Thursday evening is our show. Actually, let me give this shout out real quick. So if you're interested in that, here, if on our channel, the Node Network, our brother channel, which is us, is Unfiltered and Sovereign. And so if you click over to that, then you'll see that got the red pill Thursday at 6 p.m. and Sovereign Soil. So these are the shows where we just get together. It's usually like 4, 5, 6 people, and we just debate stuff. We drink and just talk about life in general, and hot button issues. And then I got Sovereign Soil, and I'm a homesteader, retired military. Did 22 years in the Army and Marines. Lived in a tent, and built my own cabin. So, and then now me and my brother and my nephew are starting an adventure guide company. And so I started this Sovereign Soil for emergency prep, homesteading, firearms training, all that sort of stuff. So if you want to check that out, highly suggest that you do. A lot of value there as well. Again, all of it free. So anyway, yeah, just at Unfiltered Sovereign is if you want to find that. So anyway, that's all I got. Appreciate you all. And till next time, Veteran Crypto out.
Peace.